I have with me Saugata Bhattacharya, member of the Monetary Policy Committee. Mr. Bhattacharya, welcome to this conversation. Of course, you're a long-term macroeconomic watcher, and of course, also now on the MPC. I just want to get a sense from you. When you are talking about this growth number, it surprised everybody. Every economist out there in the street was expecting a much lower number, 7.8%. I'm trying to understand how you are reading this.
So again, thank you very much for having me on your show. Always a pleasure. Of course, as you said, this was a surprise. Everybody, I think, was in the 6.5 to 7% range, maybe a little bit lower than that. We know the proximate drivers. All of us knew that these were some of the features that would show up in the GDP numbers. One was the very low inflation numbers, which feeds into the so-called GDP deflator. As you mentioned yourself, that 7.8% real GDP growth versus an 8.8% nominal GDP growth. So that's just a 1% inflation number. We knew that that was coming. So that's one. The second part is government capex. You know that in the first quarter of this year was much higher than in the similar corresponding quarter of last year of FY25. So that also pushed things. There was some expectation that front loading of exports from India to the US and other geographies prior to the tariffs coming in place would also have contributed to a very large export growth. So all of these things were known, but the surprise was that all cylinders across the GDP components have been firing on all cylinders. So every last single component. Except for mining, which we know that this has been a very wet monsoon season. So mining, electricity, that came down. And because of that, a little bit of an effect on construction. But otherwise, it seemed to be both from the output side as well as from the demand side. Personal consumption expenditure, government consumption expenditure, capital expenditure. So everything came out as very high numbers. So my sense is that even given the fact that there are these technical considerations underlying these high growths, I think overall growth momentum, aggregate demand remains pretty strong in the system.
Right. Mr. Bhattacharya, of course, you are likely to see a Q2 number soon as well. And of course, there's an expectation that that might actually not be that great, as stellar as Q1 is. But then later half of the year, you will see that festive impact coming in and, of course, broader growth impulses returning. And therefore, yearly growth numbers should look better. But vast majority of the economists and, in fact, even the government are maintaining that 6.3 to 6.8% target for FY26. I'm trying to understand from you, if you are going to have growth numbers which so far outweigh the estimates initially, do you think that it warrants or it maybe warrants a revision of that growth target, or probably too soon to talk about that?
I think it's too soon. You don't want to be shifting growth numbers on a daily basis. With every additional print coming in, that probably is not the correct way to go about it. So I think RBI, in its full wisdom, with the might of their analytic devices behind them, are sticking with the 6.5 number. So let's just stick with that, because there are so many uncertainties in the current system, in the current environment. That these growth numbers that RBI gives out are essentially just a direction of travel. So it's a broad sense of where GDP growth might land up. If other external events impact the system, there might be a hit on growth. If our domestic demand kicks in, as you articulated so well, going forward, then we might actually get a higher rate. So as of this point in time, given what we know and what our expectations are, so let's stick with the 6.5 growth number and let's see how things move.
Okay. I want to touch upon the nominal versus real GDP figure that you pointed out earlier. There's a low inflation deflator. Obviously, that is resulting in a very small sort of window between the nominal and the real GDP numbers. But overall, do you think that there is an impact on the fiscal calculations at all because of this?
There might be, obviously, because the fiscal, if I remember correctly, it was around 10%. The numbers associated with the fiscal deficit and other ratios that was given in the system, 10 or a little bit higher. So to that extent, there might be an impact. But those are technical impacts. I'm not very worried about that. Anyway, the bigger impacts that will happen on the fiscal side will be from the effects of the GST, the other subsidies that might be required to offset the negative impacts on MSMEs, other sectors of the economy. I think those will be more closely watched rather than the technical numbers, because we can all back calculate on what the fiscal deficit numbers will be, and that will be unexpected. So the other numbers, the actual additional spends and the loss of revenues that might be necessary in this current environment, that probably needs to be looked at in much more detail on the fiscal side.
I also want to touch upon the tax collection number, because that's obviously an important figure in the broader fiscal considerations. If you were to look at the GST rationalization, if you were to look at the new sort of slabs that are coming in for the income tax calculations as well, I'm trying to understand, do you think that you will want to see maybe a higher tax collection then, because these sort of work against that?
So again, I mean, from the direct tax, the slab rationalizations and the other exemptions that have been given, that those have been factored in the FY26 budget. I mean, that was there because the finance ministry had back calculated, and that's already factored into the budget numbers. The new GST numbers are the ones which are new GST on the revenue side and on the expenditure side. You also never know that, I mean, with the additional demand, expected demand that might happen, both due to actual solid demand in the system, which we have seen in Q1 coming in with the festival season, with the lower interest rates, etc. So that might actually lead to some offset of the lower tax rate collections due to the lower tax rates, as opposed to the volumes that might be generated. So that might offset some of the losses. All of these are things that we know that might happen, but we can't put a number to it yet, to my thinking.
As far as the way we were looking at where the sort of benchmark bond yield has been inching up. There's an expectation, of course, that the government will have to maybe borrow higher to sort of fill the gaps that are left back by the new tax changes coming in. I'm trying to understand from you, do you think that that's a worry, especially when we're still talking about part of that rate transmission that is not yet completed in the economy?
So on the latter question first, on the rate transmission, my guess is the numbers that we have were till the end of June, the numbers that are that were given up. My sense is that the remaining transmission would have probably have been completed over the last 2 months, in July and August. So that, to my mind, let's see the new numbers as they come in. My sense is, so again, you're seeing that despite the transmission into both the EBLR and MCLR, you are seeing banks adjusting some parts of their things of their rates to make up for a little bit of the loss in NIMs, etc. So that needs to be seen. On the first bit on market interest rates, meaning the 10 years, say the benchmark Government of India bond yield, the effects were also anticipated to a fair bit. I mean, this is what happens in the market, that once we are coming close to the end of the cutting cycle, and we have no idea. I mean, I can't put a view now on where rates might be going, because again, given this uncertainty, this has to be done on a meeting-to-meeting basis. So I mean, I'm not going to talk about that. But obviously, I mean, markets are worried that both from the domestic side as well as from the external side, both on the current account, capital account, government borrowing, etc. So all of that feed into the benchmark yield, which is the main signal of market perceptions. So all of that is happening. So we need to watch what happens. The government in the past has dealt very adeptly with managing yields beyond a certain extent to not permit too much volatility in yields. I have a feeling that they have adequate instruments, both the Reserve Bank of India and the Government of India have adequate instruments to be able to manage yield volatility as and when it happens.
I want to touch upon first on private capex and then again on private consumption. Both those numbers are actually looking quite heartening in the Q1 data that's been put out. How are you reading this? Because specifically on consumption, the urban consumption has been a cause for worry for some time now. Are these early signs that maybe that might be changing, or is this just numbers playing what they do?
Again, I mean, so one quarter's numbers probably should not be taken as indicative of a trend.
Yeah.
But we have been seeing on your channel. I mean, you've talked to various FMCG companies, say for instance, who have indicated that urban demand seems to be improving. We have always seen that rural demand for the past few quarters has had picked up, so that was a given. Urban was lagging, so FMCG companies have indicated that they see signs already. I mean, I'm not talking about the future. They already see signs of urban consumption demand improving, and they seem to suggest that they expect further improvement going forward into the festive season, etc. I mean, given all the lower costs of borrowing, more credit likely to flow into the system, the government's exemptions on tax cuts, so more disposable incomes in the hands of consumers, etc. So all of that seems to suggest that companies, FMCG companies, other consumer durables FMCG companies, seem to expect that there will be a further improvement in the consumer demand, particularly urban demand, going forward. On the other side, on the reverse side of this, I am a little bit worried about the effect of salaries not growing as fast as they used to in the past, and what we are seeing, hearing about IT company layoffs, etc. So what the net effects of all of these factors might be remains to be seen.
Mr. Bhattacharya, two questions, and I'll close this after this. But I wanted to understand from you. The first one is the massive uncertainty on the tariffs that still remains. Of course, there's likely going to be an impact on exports, and then that will likely have a domino effect on the broader employment as well as wage growth numbers. When you're thinking about the domestic growth impulses versus what these global tariffs will mean for India, do things weigh out each other, or is that uncertainty still quite predominant?
No, the uncertainty remains. I mean, there is no question that although the overall uncertainty that we had seen in April, then later on in the Q1, etc., might have been elevated to a certain extent, but the level of uncertainty specific to India relative to our emerging market peers, others, because of the high tariffs that we might still face over the rest of the year, that level of uncertainty still remains. Well, look, the US market is large, and there's no denying that. I mean, there will be a hit to a fairly large segment of exports. You've heard government estimates on all of this. To a certain extent, this might be offset by somewhat higher demand. I mean, partially at the cost of the fiscal balance. But there will be an impact if the 50% tariffs remain, assuming the 50% tariffs remain in place over the rest of the year. There is likely to be an impact. Overall, in the longer term, and I'm talking about the short term, the next 6 months, 7 months remaining in FY26. But going forward, I think the reform measures, the other steps that the government is taking together with other monetary policy measures, etc., that the Reserve Bank of India might put in place. I think over a medium term, I think many of these effects, if provided that these carry on, then there are the other FTAs that are being proposed to be signed, the FTAs that are already in place. All of that will also open up new markets, etc. So it's difficult to say what the net impact is, but in the short term, in the rest of FY26, there is likely to be an adverse impact.
I want a short answer for my last question with you, and this is about monetary policy. I know you can't give me a direction because you're in the MPC, so you can't really give me, if there is a rate cut or no rate cut in the future. But I'm just trying to understand from you in October when you sit down for that meeting again, this 6.5% number, September, apologies, yes. So I'm trying to understand from you when you sit down to have that conversation, how important will the 6.5% number be, or is it sort of already accounted for before you even start that conversation?
I think largely accounted for because the 6.5% growth, probably RBI had a good sense, the analysts had a good sense of the underlying growth drivers. But again, to emphasize once again, this is the rear view mirror growth. This is 3 months behind us now. So we need to look at the new high frequency indicators that are coming in. We need to look at the new consumer confidence surveys, the results of the various RBI surveys, what the survey of professional economists think is the likely course of the economy. So all of that will be new information. We will have another inflation print. We will have the balance of payments numbers before we come in, the Q1 balance of payments numbers when we come in. So we will have a sense of the capital flows that we see in the period. So all of this will be new information that will need to be processed.
Yeah.
So depending on that, the next steps will probably be decided.
Understood, Mr. Bhattacharya. Thank you so much for joining us on this conversation, sir.
Always.
As always, a pleasure talking to you.